Oil hit 11.11 a barrel when Iran closed the Strait of Hormuz in early 2026. A fifth of global energy shipments just stopped. I'm David, and what happened next wasn't the usual crisis playbook. This wasn't temporary pain to outlast. Instead, governments that spent years delaying renewables suddenly demanded them. The question is, how did 4 months of oil shock rewrite 2 decades of energy policy? On February 28, 2026, U.S. and Israeli warplanes struck Iranian military targets across the Gulf. By March, Iran had struck back hard: drones, missiles, naval attacks. Within weeks, Iranian forces had established effective control over the Strait of Hormuz, a 60-mile channel through which roughly 1/5 of the world's oil and nearly all liquefied natural gas travel from the Persian Gulf to markets across Asia, Africa, and Europe. Here's what that blockade meant. India imports 80% of its oil. Indonesia, 70%. Sub-Saharan Africa depends almost entirely on imports just to keep the lights on. These are countries with strategic reserves. They can't absorb even a month of zero inflows without breaking their budgets, triggering currency crashes, and freezing credit flows. For the global economy, 2022 was the Ukraine shock, painful, but ultimately managed with subsidies and time. This was faster. This was harder to absorb. Within 8 weeks, crude prices would reach levels that shook every energy-importing nation from Mexico City to Mumbai. The question wasn't whether prices would spike. The question was how far and who would break first. Within weeks, crude spiked higher than anyone expected. Watch Brent climb to $111 a barrel in Q2 2026, the highest price in years. For every gallon, every ticket, every shipping container, costs surged. For nations with no buffer, no strategic reserves, that meant import bills doubling, currencies crashing, and the economic pressure moving straight to families and governments that had no cushion left. Those price spikes landed hardest on the countries least able to absorb them. India imports roughly 80% of its crude oil. Indonesia, 70%. Sub-Saharan Africa depends almost entirely on imports just to stay powered. When crude was $50 a barrel, these nations could strain to manage. At 11.11, the math broke immediately. Import bills doubled, currency reserves drained in weeks. External debt ratios soared toward breaking points, levels that triggered defaults and currency crashes. For India, for Indonesia, for the poorest nations in Africa, renewable energy stopped being an environmental goal and became a survival requirement. You either cut oil imports by shifting to wind and solar, or your currency would crash. But transitioning to renewables takes capital, infrastructure, years, and these governments had none of it. They needed money outside their own budgets, and they needed it fast. That's when the world's development lenders stepped in. Within months, the multilateral development lenders made a strategic calculation. Before the Iran conflict, these institutions, the World Bank, the Private Infrastructure Development Group, and regional development banks, evaluated every renewable project the same way. They asked if it penciled out financially, if the returns were competitive, if the risk profile was acceptable. Pure business logic. But when oil hit $11 and energy-importing nations faced currency crises, the logic shifted. Suddenly, these lenders began asking a different question. Not, will this solar farm earn a competitive return? But, does this country need energy security badly enough that we should fund this regardless of returns? By April 2026, approvals that normally took 2 years were happening in 2 months. Lenders were fast-tracking capital into renewable projects across India, Vietnam, Indonesia, and Sub-Saharan Africa, anywhere that energy insecurity was deepest. The money was moving. But which countries would move fastest to deploy it? India didn't wait for the last dollar of lending to show up. Back in 2025, India had already hit 50% of its installed power capacity from renewable sources, solar and wind, hitting its 2030 target 5 years early. When the oil shock hit in February 2026, India accelerated harder. The government fast-tracked projects across the country's best solar and wind regions. Vietnam watched and pivoted its entire energy strategy away from coal and oil imports toward wind and solar. Indonesia, surrounded by strong island winds and crushed by oil import bills, made the same bet. These three nations had a huge advantage. They could see the shock coming and had the state machinery to move fast. By mid-2026, their renewable pipelines were filling with projects that 2 years earlier would have waited years for approval. But there was a problem. Someone had to manufacture all this equipment: the solar panels, the turbines, the converters. And one country had already captured that entire market. In 2026, China installed 276 gigawatts of solar and 84 gigawatts of wind, over 3/4 of all renewable capacity added globally that year. Dominance. Chinese panels, turbines, and inverters flooded the market. While energy-importing nations scrambled to build renewables to survive, China was already manufacturing and exporting the entire supply chain. The oil shock that terrified the world became a competitive advantage. This crisis forced a reckoning about what energy security actually means. In 2022, when the Ukraine war disrupted Russian energy supplies, governments deployed subsidies and price caps. It was triage, temporary. But the 2026 Iran shock was different. When the strait closed, governments that had spent years resisting renewables on cost grounds suddenly demanded them on security grounds. Energy independence stopped being a policy goal and became a matter of national survival. That shift is permanent. You don't reverse a national security calculation just because oil prices drop. Every government sitting on renewable projects suddenly green-lit them because geopolitical risk had overtaken cost as the deciding factor. For the first time in decades, emerging markets were willing to build renewables even if they weren't the cheapest option. But here's the catch. Nobody had built the transmission lines, the grid connections, or the permitting systems fast enough to actually absorb all this capacity. That's where the real bottleneck emerged. The real limit on renewable expansion wasn't supply, equipment, or capital. It was the grid. Connecting a new wind turbine to the transmission network requires permits, approvals from grid operators, construction of new distribution lines, and integration with existing infrastructure. In many jurisdictions, that interconnection queue was already overloaded. By 2026, wind projects were facing connection delays of up to 10 years. Think about that. You build the turbine, you secure the capital, you have government approval to construct it. But the electricity can't flow because the grid isn't ready to receive it. It's sitting in a queue of 10,000 other projects, waiting for a limited number of transmission engineers, materials, and right-of-way permits. The same constraint was choking solar expansion. So here's what happened. Governments accelerated approvals, lenders pushed capital, countries mobilized billions into new capacity. But the actual power hitting the grid remained bottlenecked by permitting backlogs that no amount of money could overcome in 12 months or 2 years. The investment was flowing. The electrons were not, and that gap was about to reshape the energy transition. But there's a pattern in energy crises that no one talked about. The strait closure was expected to resolve by late April 2026. As ships moved through, oil prices began falling. By summer, crude was dropping toward 87 a barrel, still high, but no longer an emergency. And here's what happens. As the crisis fades, so does the political urgency to move on renewables. In 1973, the OPEC embargo terrified the world into energy independence talk. By 1980, oil was cheap and everyone forgot. In 1979, Iran spiked prices. By 1981, they fell and the transition stalled. In 2022, Ukraine disrupted Russian gas. By 2024, renewables were back to being a long-term debate rather than a survival tool. Projects that looked urgent in March started looking expensive by July. Funding dried, timelines stretched. Countries that had mobilized massive renewable buildouts faced a painful choice: commit anyway or slash budgets. The pattern was undeniable. The question was whether this time would be different. But this time was different. The countries that moved fastest, India, Vietnam, Indonesia, had committed too much capital and physical assets to back away. China's manufacturing dominance made canceling more expensive than finishing. So the 2026 crisis did something energy shocks don't. It collapsed a decade of gradual transition into months of irreversible acceleration. The frontrunners had won the race before anyone noticed it was running. The oil crisis passed in months. The winners lasted forever. India, Vietnam, Indonesia, and China locked in advantages that will dominate the 2030s energy economy. If this interests you, subscribe. I'm David, and I'll see you next time.